While some online bullion dealers continue to charge $4 over spot for U.S. Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with SD Weekly Metals and Markets Wrap. Joining us today is our good friend and the silver guru himself, David Morgan. David, it's great to have you back with us.
Well, thanks for having me.
All right. Well, both gold and silver ripped higher this morning at 8:30 on the jobs report as the non-farmers payroll disappointed, and we were chatting before the show, guys. Really pretty much shaped out exactly how we expected with all of everything that went on last week at Jackson Hole and just the drubbing that gold and silver experienced as pretty much the entire market was jumping on the Fed's propaganda that they're going to hike rates in September. And I pretty much firmly believe that there's no chance in hell that they were hiking rates 60 days before the elections, which means that the Fed had to give themselves a way out, a way to not hike rates in September without losing all of their remaining credibility, which, as Eric remarks often, they have none already left over. So that set up today's jobs report. It was a miss, and gold spiked about $25 instantly. Silver spiked back above 19, really about 50 cents. And silver's actually been the more impressive metal here. We're recording early, about 1:15 New York time right now, and silver's been consolidating its gains throughout the afternoon. Gold is a little bit, maybe I think about $10-15 off the highs, only holding on to about half of the gains so far. So let's start with the trading here and the reaction today, David, and what's your take?
Well, the reaction I think was pretty much expected. I did an update for our members saying basically what you said. If jobs report came out really, really strong, then you would see gold push down and testing the 1300 level. And obviously it wasn't a good report, and gold has reacted to the upside. What we said about silver, I'd like to comment a little further on, and that is, in a bull market, what I really like to see is silver taking the lead, which it has now, and that the up days are like 3 times the percentage that gold is. So right now, as you said, silver's kind of consolidating its gains, which means gold's up about 0.63% according to Kitco, and if you multiply that by 3 or 4, you'd be about 2% in silver, and that's what we see. Silver and gold both are really trading much differently this entire year than they have in a very, very long time.
Kind of piggybacking along those thoughts, David, is if you look at a chart for silver, it really looked like technically silver should correct all the way back to 18 and bounce off of 18, but it didn't get to that level. I think about 1855 was the lowest it got, and anybody who is waiting for that full retest in that 18 level may have missed the bottom.
It's possible. I had a consultation with a longtime member yesterday. He was arguing that. I would, technically there's not a lot of support there, but it doesn't mean that it isn't. And the big support's around the 1750 level. A lot remains to be determined. There's still a huge open interest, but as we should discuss, the amount of paper products that have been sold, particularly on the gold side, 1.5 billion in gold on a paper trade, and the market kind of ho-hums it. So then they go, I think it was 4.5 billion, and the market says ho-hum again. This is unprecedented. We haven't seen this kind of paper paradigm where the powers that be sell massive quantities in the paper paradigm and not get some kind of trigger function, which means that the brain-dead trading funds start to sell their positions, and you start to get either a waterfall decline or a pretty healthy decline within a matter of a few days. And this is not taking place, which gives the market participants a great deal of faith that things are different. And I'm convinced that not only is the market trading differently, that's not an opinion, that's a fact, but that what lies ahead for the metals is extremely bullish going forward.
Yeah, and we see that different trading pattern all year. It's even visible in silver this week, and silver not getting below 1850 is the kind of artifact of just the dip buyers of these long interests that are chasing after the short interest that J.P. Morgan and their friends keep dumping into the market, and they're not giving up the longs that are wanting in silver, combined with what clearly, I mean, there's different buyers, and I think sometimes people need to stop and think about it and appreciate that aspect of it, because the stacker community is very different from the speculators and maybe the insurance brokers or whomever, within the financial community, the 95% monies under management that are managed by conventional thinking folk. That whole gigantic tidal wave is beginning to sniff around precious metals, and those are the kind of buyers that are perfectly happy to go after the COMEX buying, accumulate, do the roll, buy their December contracts, and not budge. Despite this war with this ever exploding, I mean, we've seen maybe some 20-some-odd% of open interest in the COMEX silver contracts decline, and there's been some of the pressure relieved in this decline that we've seen, this attack in the last 2 months or so with this long consolidation. And it's clear that these buyers want in. They want exposure, and the market in the grand scheme of things is actually really tiny compared to the pool of capital. And that's really the paradigm, I think, that David is speaking of. It's the biggest change we've seen all year. I don't know how many times we've seen silver in particular. Gold's been able to bounce like a trampoline too, but nothing like what silver has done this year. And that's what I'd love to ask you, David, and lean on your really long decades of experience in watching markets. Is that really one of the tells that our listeners really need to appreciate, is just how amazingly resilient in the face of what we know is this monumental manipulation that silver in particular has been all year, and these paper buyers versus all the weird signals we get, with the mint not producing as much, and the allocation games that Doc and I have been talking about when it comes to authorized purchasers building an inventory earlier this year and then working down that inventory, and weird things with premiums and all of that. I mean, I'm throwing out a lot here, and I know you can handle it, so I'd love to know what your thoughts are.
Well, yes, Eric, and there's not a lot I could add on to, and I will try to basically reiterate what you said. What's happened is early in the year, meaning, February, March, April, a lot of non-players came into the silver market, exactly as you said, through the futures market. There's a philosophical difference between silver stackers and the investment community at large, meaning, as you said, pension funds, money managers, school boards, whatever. And they've got exposure to both the metals through the futures markets, but they've got good positions at relatively low prices, and they cannot be shaken out. And this, of course,
pockets.
Right, and deep pockets. And this is a concern, I'll put it in polite terms, a concern to the shorts, because every time in the past, or nearly every time that they've tried to orchestrate a massive sell-off in the paper paradigm, it's worked, and it isn't working. On top of that, you have the SGE, the Shanghai Gold Exchange, which is almost a one-for-one correspondence with the COMEX, meaning for every short there's a long and vice versa. Well, they're mostly long against the massive short position that the bullion banks and commercial banks have in the precious metals. So the fight between the bulls and the bears is pretty equal. Before, it used to be, the analogy I used to use, and we'll use again, is that sitting at the poker table and you sit across from, the sheikh from Saudi Arabia, and he's got 20 million in chips, and you're sitting there with $100,000. Who do you think's going to win the poker game? That's more now like Wang Fu Song is sitting on one side of the table, and the bankers are on the other side, and their stack of chips is about equal, and they're not budging. They play the game really, really well. So hopefully you like the metaphor, but this is what's happened, and this is new, and this is going to carry the metals far higher. And going back, adding just a bit more, as you said, you have to always look, and I've preached this for a long time, is there has to be new buyers. And that's what we have. We have new buyers through the, let's call it the conventional investment community, and this will only continue as things deteriorate through the old Yeller or old Yellen trying to say it's data-driven. Well, if it's data-driven, guess what? It's going to drive the metals far, far higher.
And certainly if this is the start of a third stage of the secular bull market, this is just the beginning of new buyers entering the market.
Absolutely. I mean, I don't like to say this, but I'll say it, and it's opinion, but I think it'll be proven by fact eventually. There will be more silver purchased above 30 than below 30. No matter how much silver doctors do, or I do, or any of the writers or noted analysts in the precious metals talk about, buy it, under 20 if you can, buy it under 25 if you can. The public follows, they don't lead. And what will happen is once the momentum really goes and the mainstream press starts to give coverage to the precious metals again, you'll see a lot of people that will buy it at, nearly double the price we are right now. And that's unfortunate, but that's just how markets work.
And along with it, I'll throw this in here. At SD Bullion this week, we were analyzing the Hispanic market in the U.S. This is something we noticed is pretty much completely untapped. There's no bullion dealer that reaches the Hispanic community in the U.S., and it's a pretty significant portion of the U.S. population in the South. I mean, not just the South, but particularly in the South. So we did some research and analytics. I'll throw it out here for you guys. Take a guess. The terms, the Spanish terms for like buy silver and buy gold, how many times do you think that's searched a month?
You mean like in the United States or North America searches?
Right, actually in the States, online. Compro oro or compro plata.
Minuscule, like 10 times in a month.
I think it's huge. I think it's really big. What is it?
Eric pretty much nailed it. The term buy silver is searched one time per day. Buy silver in Spanish in the entire U.S.
Yeah, and that's not to suggest that the market isn't there. It's just that people aren't searching for it because they're not, they don't think in those terms. But probably wouldn't take them. I mean, we have the plata. Or the Libertad, sorry, I was not remembering the name. The Libertad coin, that sells reasonably well in Mexico, and silver is something that is in the Mexican culture even more so than the United States, I think, in terms of their coinage history and all that.
But it tells you the Hispanic population of the United States, gold and silver is not even on the radar for 1,000th of 1%. Yeah. And I mean, when you hit stage 3 of a bull market, I mean, the whole entire population wakes up to that market and that trade. I mean, not everybody, but a segment of all the population. So, I mean, that's the potential for new buyers, like you were talking about, David. This market is far from tapped out for the potential for new buyers to enter the market.
Yeah, well, I certainly proved that I don't know everything about the silver market. I was thinking about my friend Hugo Salinas Price and the amount of effort he's done with the Libertad, and the word plata means money. As you know, and so I thought, even in the U.S. would be, I thought it'd be significant. There's so much.
I thought it was too. I was right along with you until we looked at the numbers. I couldn't believe it.
Interesting.
I'm just a curmudgeon cynic. What can I say?
I guess. But anyways, on that note, looking at the numbers here this week, I mean, at SD Bullion, we've continued to see very strong silver demand, and we've seen the trend continue that we first reported last week, really over the 24 hours before we recorded the show last Friday with everything in Jackson Hole. Everything dried up, and all the massive amounts of secondary silver inventory that was on the wholesale market really over the past 2 months since silver first jumped up towards $20, and there's just a massive amount of rounds, bars, 100-ounce bars on the secondary market. That's continued to dry up and evaporate this week here. Again, premiums on the 90% silver continue to creep up. So again, it's not anything near.
What did they creep up to?
About 20 cents this week on the wholesale market. So again, it's not anything massive. It's not massive premiums. It's not a shortage, but pendulum has begun to swing the other direction after about 6 months straight of declining premiums and great availability in 90%, which for new listeners, we've remarked for a long time, 90% silver bags often are a leading indicator for the retail silver market as far as both supply, availability of supply, as well as premiums. Usually we'll see premiums start to jump on 90% before anything else. So again, it's nothing dramatic yet, but we've seen premiums rise maybe 25 or 40 cents now in the past week and a half, just indicative that pendulum has begun to swing in the other direction. So we'll see what happens in the market and see if that trend continues.
I'd like to just throw in a couple more ideas here. These are just headlines. We talked about the jobs report, but looking from a more global perspective, we have the Hanjin Shipping is now seeking receiverships and ports are turning away its vessels. The tough economic outlook in Brazil after the president is removed and the Brazilian economic collapse reaches unprecedented proportions. Canada has the worst GDP since 2009. The global economy, Canadian economy, shrinks at the fastest pace since the last financial crisis. Negative interest rates through central banks as they race to the bottom. We all know about that. Investors miss out on a $500 billion windfall as global bond yields plunge, according to Fitch. Deutsche Börse responds to Deutsche Bank's failure to deliver physical gold. Maybe we should stop there and discuss that one a bit.
Thoughts on that? That's really the big story in the physical markets this week. So why don't we pause there and focus on that for a couple minutes, David?
Well, Eric, why don't you go ahead and chime in on it? What are your thoughts?
We've seen a lot of examples of these kind of failures to follow through on the contractual obligation of delivering gold when a customer steps up to the table. And they're always anecdotal. It's hard to say, okay, this is proof that the entire system is drained of its gold. We can't make those kind of inferences, but we've seen really big examples such as ABN AMRO shutting down their entire gold business back in 2013, right before we saw that, April around tax season, the drive-by shooting in the precious metals market with, some $200 down day in gold and all that turmoil that happened around that time frame. These anecdotal cases and the fact that we know that there's squirrely things going on with ETFs too, and Bob Pisani showing a serial number that some hedge fund guy is able to identify as his bar, but it isn't supposed to be in the GLD inventory. All these weird things that on an anecdotal basis don't necessarily amount to a hill of beans. But if you look at what we know, when you plug that into the context of what we know is going on in these markets and the manipulation that's going on, it's pretty darn clear that there's a real big problem here, and more people are going to begin to start requesting to have allocated storage or get redemptions or what have you. And I think that's everyone talks about the COMEX as being where the default's going to happen, or frequently talking about how COMEX is going to default. And I know that David, you do an outstanding job just completely eviscerating that kind of an argument, because it will never happen. I mean, in part because of the position size limits, and the COMEX is definitely got a lot of fraud going on, but that's probably not where the system breaking default is going to happen. It's going to be one of these weird little things around the edges that just is going to be the snowflake that's enough to bring the avalanche of psychology in the gears of people's fear about not having the insurance that they're supposedly exposed to when they're buying bullion. And then enough people are eventually going to wake up going, oh, gee, 100 to 1.
It may not be COMEX. It may be a well-known depository. And kind of tying those thoughts together, Eric, the whole thing with Bob Pisani on CNBC, I mean, that's, in my mind, that's rehypothecation is what the issue is going on there. Yeah. And we actually, bringing the story close to home, I mean, we had this summer a customer of SD Bullion storing 7 figures worth of gold and silver bullion in a very well-known U.S. depository, and he had decided that he wanted to take advantage of, at SD Bullion, this summer we started offering a special program with pretty aggressive rates in storage in the Cayman Islands, which is outside of U.S. jurisdiction, and it's completely secured and allocated, and the rates are very affordable, but so when he went to make the move, and we're talking with him about his rates, he was being charged a flat fee of $200 a year for storage of 7 figures of gold and silver bullion, which tells you that they're not storing his bullion. I mean, just the insurance alone is exponentially more than that on that kind of amount of money. That tells you that they're just charging him a fee for a paper claim to gold, and then as long as he gets in line first when he wants it out, he'll be okay. That gold's been rehypothecated probably hundreds of times because it's the only way mathematically it makes sense, or that depository is not going to be in business. You know what I'm saying, guys?
Oh, yeah.
Absolutely. I have a guy that's done some research for us from time to time, and he had holdings at one of the mints, and I won't say which one. I don't need anybody, taking me on, but it took forever. I mean, it took like 3 months for him to actually get delivery, and this was during a quiet time in the market. So I can just imagine some of these people that store, and there are good places to store. I have recommended have it in hand, or at least have a good portion in hand. And if you're wealthy enough where storage is an option you pretty much need to do, then be very, very, very selective of who you store with, because even of some of the well-known names, I mean, we know how many here recently. I mean, to digress a bit. Northwest Territorial, I mean, I've gone through their facility 3 or 4 times. I mean, I've held their gold bars and, seen the whole process. I've taken friends that wanted to go with me and on and on. But it was one of the facilities that I really never recommended. I was questioned about it many, many times. But the reason it wasn't at the top of my hit parade was they were notoriously the slowest deliverer in the industry. And that's not what people want. They want, cash on the barrel, check clears, where's my precious metal? As it should be. But they have never, in my, since I've known them, operated that way. And of course, they blew up, as we all know. And then there was the other one, what was it, Bullion Direct? I mean, this is something that, kind of gives silver and gold a bad name. Silver elements, their money, they're exempt. They are just pieces of metal that are valued very highly by human beings. It's the people that are involved in the industry that you have to be, leery of.
And it requires critical thinking. I mean, just like anything in life, if something sounds way too good to be true, you better investigate it. It probably is. It costs money to store bullion. It costs money to insure bullion.
Exactly.
So if you actually have bullion sitting there, it's the storage isn't free.
And we live in a world where there's less than 1% of financial assets in so-called bullion, and the percentage of that's physical, what is it, 3%? I mean, it's unbelievable how little real bullion is actually around and available for investors should they want it.
Well, I think maybe I'll tell this story. I can probably do it shortly, but you know how long I've been in the precious metals. And I used a leverage program back when I was in my 20s, and basically you could put up like 1,000 ounces of silver and you could borrow enough cash for 2,000 ounces more. And I was leveraged about that far, and there was some problems with the bank, so I cashed out my silver and gold mutual funds, had the cash, went down, paid for everything, and took the 100-ounce bars, all 30 of them, out of the bank. And so they're all mounted up on a couple of hand trucks with a couple of guards with guns and parked out in the no parking zone with somebody watching the car, and they're wheeling out all these silver bricks, 30, it's not like, I'm not Bunker Hunt. And as we go wheeling by the front office, one of the secretaries says, and I quote, "Wow, I've never seen any silver before." What? This bank does millions in leveraged loans and precious metals, and it's all based on quote unquote, real silver and gold put up as collateral. And wow, I couldn't get out of there fast enough. So this is one from my past of probably 30 something years, 40, but it's a true story.
That's not too surprising. All right, well, before we wrap the show here, David, let's take a look at the fourth quarter in the fall here as we get underway, and just with the election cycle, and as we get past Labor Day here on Monday, and all the traders get back to their desk to work here for the next couple of months. What's your take on the market as we sit here for gold and silver as we get going here in the second half?
Well, I'm obviously very bullish, and I'm not a permanent bull. I mean, I basically called every market top pretty closely all the way up. I certainly have not done as well calling the bottoms, but the bottom is in as of last year, November, December. I'm looking for the third leg up. I think we're looking for, maybe 3 to 5 years. I'm more partial to maybe the 3-year time frame, but I think it's going to be the longest and most bullish move in the precious metals probably in recorded history, but I don't want to be too hypey. Nonetheless, it takes time to get there. I mean, this is a year of building back the psychology, I'll call it, in the precious metals. I'm actually not very bullish the commodity sector as a whole, save the food stuffs. But we have got overcapacity everywhere. The economy is contracting on a global basis. People are scared. The situation is basically a crisis mentality, really, if you analyze it and don't mix your words or sugarcoat it, which means there'll be more and more money, as Eric talked about, that 1% that's invested now. If that becomes 2%, that doubles the amount of money moving into the precious metals. What if it went to 5 times, which is what I expect? I think at the top of the market, we'll probably have like an increase of maybe a factor of 3, 4, 5 of what we have right now. And as we discussed earlier on your show, who are the new buyers that are in the market now and how strong the hands are they? Just imagine where it can go as things deteriorate further and the run to gold begins. Because once the run to gold begins, as it's often quoted, there's no fever like gold fever. And that psychology, when it goes through the masses, is going to take these markets to places they've probably never been.
Couldn't agree more. And I think we finally have turned as well. It's been a long 2 months plus of consolidation in the sector. But this whole the cycle of the job owning the employment report that we saw print today, and these in the context of the election and where we are, I mean, these data points match up and they make sense. So, we had to go through J.P. Morgan trying to push comic silver down, trying to keep that explosion past 2150 happening in the post-Brexit world and all of that. But what we're seeing makes sense, and it conforms with what is a rebirth of a gigantic bull market, and I think we finally have turned. So with Labor Day coming and India coming back online and the strong fourth quarter season and the conditions that we see with the physical market tightening up and proving out that our theory about what was going on with the authorized purchasers explains the goofiness of the weird things with the U.S. Mint numbers and people freaking out about that. I mean, all these data points are beginning to make sense, and that gives me the confidence to think that our initial understanding and forecasts of where things were are in fact playing out. So I think this is going to be one heck of a year. It's going to be explosive in the fourth quarter, and it's just a question of all the constant times that we have to get over all the various points where the cartel puts the no moss line in the sand and fights back. And that's what we've been doing for the last 2 months when it comes to trying to get over and stay over $20 silver, et cetera, et cetera. But, miners are doing fantastic today, too. Everything is conforming to what you would expect to see when you're looking for an inflection point. And I think that that's what we're looking at today. And we turned, combined with, finding some firm footing yesterday when it comes to precious metals as well. So this looks good. I'm looking forward to the remainder of the summer. I think we're going to have a really strong move.
Yeah, it should be a good fall. Couldn't agree with both of you more. I think we have the setup here for quite a potentially explosive fourth quarter. So before we close, David, if you can let the listeners know where they can sign up for your newsletter.
You bet. Just go to themorganreport.com, all one word, themorganreport.com. Get on our list, just first name and an email address, and I'll send you the Riches and Resources report for absolutely free. The beginning, there's 2 movies to watch. One is called The Four Horsemen film that talks about the Age of Empire and how this cycle is replayed over and over again through history. It's a great tutorial for people that already know a lot about the sector, but especially for somebody that, maybe a parent or a grandparent or somebody that's really not up to speed. It's well done. And then there's a second film that was titled The Empty ATM, which is a documentary about the currency crisis in Argentina, 2000-2001. So one of the most often questions I get is, well, what will it look like? Well, this is exactly what it looked like in Argentina. Does that mean that's exactly how it's going to look like in Brooklyn, New York? No, it isn't. But it does give you a good overview of what took place when people's funds were held by the banks and they could only take out a very limited amount. Then the devaluation took place. So the banks basically took total advantage of the people. And this documentary outlines it without any any added commentary. They basically just give you the facts. This is something I think everyone should at least take the time to watch so that they have an idea of what could happen and probably, in my view, will happen probably throughout the world at some point. I really believe that. I don't like the idea, but all fiat currencies through all of history have failed, and to think the dollar alone will survive this is very wishful thinking from my perspective.
All right, so definitely check that out. And David, thanks for joining us again. Always great to have you back.
Thanks for having me. Appreciate it.
All right, we wish everyone happy and safe Labor Day weekend, and we'll be back with you to start the fall next Friday. So for the Doc and Eric Dubin and David Morgan, thanks for tuning into this week's SD Weekly Metals and Markets. Shaped out exactly how we expected, with all of everything that went on last week at Jackson Hole and just the drubbing that gold and silver experienced, as pretty much the entire market was jumping on the Fed's propaganda that they're going to hike rates in September. And I pretty much firmly believe that there's no chance in hell that they are hiking rates 60 days before the elections, which means that the Fed had to give themselves a way out, a way to not hike rates in September without losing all of their remaining credibility, which, as Eric remarks often, they have none already left over. So that set up today's jobs report. It was a miss, and gold spiked about $25 instantly. Silver spiked back above 19, really about 50 cents. And silver's actually been the more impressive metal here. We're recording early, about 1:15 New York time right now, and silver's been consolidating its gains throughout the afternoon. Gold is a little bit, maybe I think about $10-15 off the highs, only holding on to about half of the gains so far. So let's start.
Trigger function, which means that the brain dead trading funds start to sell their positions, and you start to get either a waterfall decline or a pretty healthy decline within a matter of a few days. And this is not taking place, which gives the market participants a great deal of faith that things are different. And I'm convinced that not only is the market trading differently, that's not an opinion, that's a fact, but that what lies ahead for the metals is extremely bullish going forward.
Yeah, and we see that different trading pattern all year. It's even visible in silver this week, and silver not getting below 1850 is the kind of artifact of just the dip buyers of these long interests that are chasing after the short interest that J.P. Morgan and their friends keep dumping into the market, and they're not giving up the longs that are wanting in silver, combined with what clearly, I mean, there's different buyers, and I think sometimes people need to stop and think about it and appreciate that aspect of it, because the stacker community is very different from.
While some online bullion dealers continue to charge $4 over spot for U.S. Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with SD Weekly Metals and Markets Wrap. Joining us today is our good friend and the silver guru himself, David Morgan. David, it's great to have you back with us.
Well, thanks for having me.
All right. Well, both gold and silver ripped higher this morning at 8:30 on the jobs report, as the non-farmers payroll disappointed, and we were chatting before the show, guys. Really pretty much with the trading here and the reaction today, David, and what's your take?
Well, the reaction, I think, was pretty much expected. I did an update for our members saying basically what you said. If jobs report came out really, really strong, then you would see, gold push down and testing the 1,300 level. And obviously it wasn't a good report, and gold has reacted to the upside. What you said about silver, I'd like to comment a little further on, and that is, in a bull market, what I really like to see is, silver taking the lead, which it has now, and that the up days are like 3 times the percentage that gold is. So right now, as you said, silver's kind of consolidating its gains, which means gold's up about 0.63% according to Kitco, and if you multiply that by 3 or 4, you'd be about 2% in silver. And that's what we see. Silver and gold both are really trading much differently this entire year than they have in a very, very long time.
Kind of piggybacking along those thoughts, David, is if you look at a chart for silver, it really looked like technically silver should correct all the way back to 18 and bounce off of 18, but it didn't get to that level. I think about 1855 was the lowest it got, and anybody who is waiting for that full retest in that 18 level may have missed the bottom.
It's possible. I had a consultation with a longtime member yesterday. He was arguing that. Technically, there's not a lot of support there, but it doesn't mean that it isn't. And the big support's around the 1750 level. A lot remains to be determined. There's still a huge open interest, but as we should discuss, the amount of paper products that have been sold, particularly on the gold side, 1.5 billion in gold on a paper trade, and the market kind of ho-hums it. So then they go, I think it was 4.5 billion, and the market says ho-hum again. This is unprecedented. We haven't seen this kind of paper paradigm where the powers that be sell massive quantities in the paper paradigm and not get some kind of